So how I discovered options trading originally was around 2012, 2013, somewhere in that time frame. I discovered TastyLive. TastyLive is a video content network. These guys broadcast for several hours a day, and all of their content is centered around options trading, research pieces as far as back testing, different option strategies and things like that. And it's just a fantastic content network. If you're not subscribed to TastyLive on YouTube, subscribe to them on YouTube. Also go to TastyLive.com and follow their content on their own website, because they've got like tens of thousands of hours of video content. You really can't search through it, their back catalog, in a proper way on YouTube. Go check out their website, TastyLive.com. But one of the things that really made me excited about options trading, and one of the things that probably influenced thousands and thousands of people to give options trading a shot back then, was, they had this guest in 2014, Karen the Supertrader. Now, this lady was named Karen Bruton is her real name. They dubbed her Karen the Supertrader. And this lady, she took about $100,000 and created a little fund, right? And her and a group of traders, like 6 or 7 traders, they, over a number of years, grew this fund from $100,000 to over $300 million. And how she did that was she was trading options. She was essentially trading Strangles on SPX. And obviously, as somebody that was looking for a way to make money and was kind of interested in options trading, I hadn't really began trading options at that point, but I was interested, and certainly a lot of people were interested. Really, TastyLive got thousands and probably hundreds of thousands of people interested in trading options that never would have traded options otherwise, thanks to their content. And specifically in the early days of their network, all of these interviews with Karen the Supertrader, because she really inspired us. She made us feel like, what, we can do this. Now, Karen's story basically started in 2007. She starts trading with about $100,000, and she quickly grows it into like $170 something million by 2014. And by 2016, she runs into trouble with the SEC, and they essentially shut her down. She gets fined. She has some charges of fraud, some fraudulent accounting practices, basically, because the way she ran her fund is she only got paid if she won for the month. Like if they had a winning month, she got paid. If they had a losing month, she didn't get paid. And for many, many years, Karen had this streak of, nearly every month winning. Like it was very, very rare for her to have a losing month. That's how she was able to grow a small amount of money into, $300 million or whatever it happened to be at the end. But there was like a year and a half period of 2014 to 2016. There was like an 18-month period where most of her months were going to be losing months had she reported them correctly. So she fudged the numbers. She was basically rolling losses out, so she didn't have to report a loss for that particular month, so she could still charge her fee and get paid, which of course is fraud, right? But here's the thing. A lot of people, when she got in trouble with the SEC, got fined. She's no longer allowed to trade other people's money now. But a lot of people, when they saw that, they were like, man, she wasn't even a real trader. She was one of these fakes, one of these frauds. Well, no, that's not necessarily the case. She traded, real money and made real money. Like there was nothing fraudulent about her trading or the money she made, the success she had. What was fraudulent was there at the end, she was basically cheating some of her customers out of paying her a fee that was not deserved. But as far as I know, none of the customers for her fund, nobody ever lost money because of Karen. And of course, because she had these charges against her, the TastyTrade guys really took a lot of heat years after the fact, because, they had her on the show several times. And then, a few years later, this lady is in trouble. She's got all of these SEC fines, and, she's got charges against her. And then she loses the right to trade other people's money. And then people were like, well, you TastyTrade guys, you were promoting this fraud. Maybe you were in on it with her. And, it really, what people need to just chill out a little bit, because these guys back then in 2014, when they interviewed her, they didn't have TastyTrade as a trading platform. TastyLive, the content network, was actually called TastyTrade back when they ran this. They didn't have a trading platform yet. So they were on Thinkorswim. And the reason Tom Sosnoff knew anything about Karen is because, before he sold Thinkorswim to TD Ameritrade, of course, Tom Sosnoff was the creator and owner of Thinkorswim. And he was her broker, like the Thinkorswim guys, obviously see what all the traders are doing. It's like she's probably getting contacted by their risk management team about some of the risks she's doing with all these Strangles and XPX, and so they know that she's really trading real money and that she actually is really winning. There's no cheating the broker as far as the broker knows if you're a winning trader or not. So Tom Sosnoff absolutely knew that Karen was a winning trader. And again, that's not to excuse anything that went on with some of the fraudulent accounting practices and all of that, but what, she was found guilty on that. She paid her fine. She was punished for that. That's fine. But as far as her trading strategy, there's no denying that she had some extreme success, because in these, she did about 4 or 5 different videos on TastyTrade over the years. They interviewed her a number of times, and she never really gave hard specifics. There was never, she never came to the show and gave an exact game plan of, how she traded her Strangles on SPX. But today, I've watched these videos enough over the years, I kind of can guess some of what she's doing. So today, what I want to do is I want to actually discuss what I think Karen was doing trading these Strangles on SPX as far as some of the strategies she was employing. So let me switch over to the TastyTrade platform. Let's first talk about why she trades SPX. Well, the reason she eventually became essentially a single product trader for the most part, why she stuck to trading SPX, is because once she grew this fund from $100,000 to I think in 2011, I've got some notes here. By 2011, 4 years later, her fund was worth $41 million. So they grew $100,000 into $41 million. With $41 million, you're a big trader, right? It's kind of hard to trade a smaller product like SPY, right? You can't really trade the SPY. There's so many, you have to buy so many contracts and you're paying so much in commissions. You want the biggest product possible. The biggest product possible as far as the S&P 500 is the SPX. Now, she did mention in some of these interviews, although she primarily traded SPX, occasionally she would trade the ES futures if she needed to put on more trades and for whatever reason didn't want to put those trades on in SPX. Sometimes she would use ES. She also used NDX and RUT on occasion as well. NDX is the NASDAQ index, where SPX is the S&P 500 index. RUT is the Russell 2000 index. And she liked the index products because they're big boy products. They're really big products. And if you're trading with a ton of money like she is, that's what you need to be trading. You need to be in the big products. Also, because they're indexes, there's no shares, right? There's no assignment risk. Everything settles to cash. Now, some people might say, well, SPX and NDX, they're okay, but isn't liquidity better in the ETFs, SPY and QQQ? Well, SPY and QQQ are extremely liquid products. The problem is when you're trading with a ton of money, though, you don't want to buy 10 SPY contracts when one SPX contract does the trick. And with NDX and QQQ, it's even worse. I think one NDX contract is like 40 QQQ contracts, right? That's just too many contracts. That's too much fees and commissions for that. So that's why she gravitates to the bigger products. It's for less fees. It's also tax advantaged when you do index products like SPX rather than equity products like your ETF products like SPY. Now, again, Karen never really just nails down any specifics, and that's partly probably because she doesn't trade by a strict, rigid game plan that's, like you can reduce to, here's a few rules to trade by. Here you go. It's something much more complicated going on with the trading strategies her and her team are employing. She had a team of about 7 full-time employees, all of them watching the markets all day. They were making somewhere around, I think, 50,000 trades a year in SPX. So it's a very active kind of trading firm here. So this is not something that necessarily you, the small retail trader trading by yourself, is going to duplicate. But again, her story was so fascinating. People want to know some of the details. So what I have gathered is that when she did these Strangles, she did not enter them as Strangles as far as one trade. She typically put on the puts, by themselves and the calls by themselves, and she played each side separately. She did not see them as a strangle. So even though she says she was trading strangles in SPX, she's really selling naked calls and selling naked puts separately. Obviously, they form a strangle. If you wanted to look at the risk profile, you know, the total portfolio risk profile, for example, would look very much strangle-like, but she's really managing each side of the strangle separately. And she also was putting on more puts than calls, which is something I really like, because one of the things that I hate about the TastyLive content, they sell so many strangles, and specifically when they do all their studies, they're always doing strangles, delta neutral strangles, right, in SPY. And SPY, all the S&P products, right, what do? Well, they drift higher. They have a positive drift. They tend to go up over time. Why would you ever purposely limit yourself to just selling delta neutral strategies on a product you know tends to go up? It doesn't tend to trade sideways, it tends to go up. So you need to do more bullish strategies to win in the long run on a product like SPY or SPX in this case. So with her, what she's doing, she's selling a lot more puts than calls, and that makes sense because SPX tends to just go up. So the expiration she liked 56 days. I'll go to the 55-day cycle here, and she chose 56 days because that's exactly 8 weeks. You do 7 times 8, that's 56. She always traded the monthly cycles. She always open trades and close trades on the Friday. So your Friday expirations, your monthly expirations typically. So she liked to go 56 days out, and she liked to sell her puts at 2 standard deviations. Now, I'm recording this on the weekend, and it looks like the charts here, the chains here in TastyTrade are not loading as far as I wanted to see the deltas, but I know where the 2 standard deviation put is because of the line here. So the first line's the 1 standard deviation line. This line here is the 2 standard deviation line. So this put right here should be the 2 standard deviation put around it. This is going to be a 5 delta put essentially, even though it's showing 0. Again, it's recording on the weekends. There's no data being fed into this right now, but it's a 5 delta put. Typically what Karen would do, she would do twice as many puts at least than calls. So let's imagine for the puts, every time she does a put, it's 56 days, 2 standard deviations, and she sells 2 puts. And that's kind of what she was doing on the put side. Now on the call side, she did not do 56 days, and she did less calls than puts, obviously. She liked going shorter time frames on the call side. So what she was doing, she was typically going, I want to say about a month out, maybe 30 days, say 33 days in this case. And on the calls, she wasn't going to the 2 standard deviation line. She was only going about 1 standard deviation on the calls. So she was going somewhere around, you know, the 15 to 16 delta on the call side, maybe a little farther out, maybe somewhere out here to where it would have been like a 10 delta call, probably somewhere around the 10 delta is my guess. If she's doing like a 2-to-1 ratio, if you want to make it delta neutral, you know, you sell 2 5 delta puts and 1 10 delta call, you're kind of delta neutral at that point. If you start leaning the call in too much, you become actually a little bearish in direction. So she's probably going more like a 10 delta call versus 2 5 delta puts. And maybe if she wanted to lean a little bullish, because SPX does have that positive drift, maybe sometimes you do 3 puts versus 1 call or whatever it happens to be, because the call does have a negative expectancy. If all you do is sell calls on a product like SPX, that's a losing strategy. We know that. So why would you trade calls? Why would you sell naked calls on a product like SPX? Why wouldn't you just do the put side? Because a lot of people ask this all the time. It's one of the complaints I see people ask the TastyLive guys. Hey, why do you sell so many strangles in SPY? Why wouldn't you just do the put side and forget the calls? And it's a perfectly valid question. But here's the thing. You know, sometimes you want to sell a bunch of puts. Sell a put every week in SPY or put every week in SPX or whatever it happens to be. You start getting a little too long. So to take off some long deltas, occasionally you'll sell the occasional call to reduce those long deltas. So it's not like you can't sell your puts, you know, maybe sell a lot of puts in some cases, but you got to hedge in some cases. Some cases you get a little too far ahead of yourself selling all those short puts. So selling some calls against them every now and then just to reduce reduce your overall deltas is actually a pretty smart play. So let's take a look at the risk profile on this kind of example trade. So I've got this call. I'm assuming this call is probably around the 10 delta. Again, I don't have a guide marker, but that's somewhere in the ballpark of where she would do a call around 30 DTE. Let's go put on the puts. I'll go 55 days since there's not a 56-day cycle. I'll go to the 2 standard deviation line. I'll double up on the puts. And if I go to the analysis, and let's go ahead and zoom out as far as we can. And this, of course, is your typical risk profile of a strangle. We've got a little bit more risk, obviously, on the put side because there's 2 puts. You know, should the market come crashing down in a big way, and the market, when it crashes, it always crashes down. It never crashes up. That's why you get those puts much further out than the calls, right? That's why she's selling 5 delta puts and only selling a 10 delta call, because the real risk, you know, you really want more cushion on the downside, because when the market makes down moves, they tend to be much more drastic, much more violent. The market never makes a violent move up, right? And you never wake up one morning and the market's up 20% in a day. That doesn't happen. The market often does crash 20% in a day. When I say often, you know, it's done it a handful of times in history. So, you know, this is obviously the dangerous side, right? The put side. And because the markets are not open, and I'm not really getting any quotes as far as, you know, deltas, any of the Greeks, probability of profit, I will say probability of profit, you're going to win on this kind of trade probably somewhere between 90 and 95% of the time. You're going to win at least 95% of the time on the put side, being 5 deltas out, probably because of the positive drift. You can expect to actually win on the puts like 97% of the time, 98% of the time. The puts are so far out, you're good on that. Your calls, being at a 10 delta, they're going to get punished a little more than you'd think. Instead of losing 10% of the time, you might lose 15% of the time on the calls, but that's still fine. You'll win, you know, still 85% of the time on the call side. So overall, you're probably going to win on both sides of the trade, like 90% of the time. So, you know, pretty safe trade. Now, where is the risk? Well, the risk is really when the market is one directional. The call side you're less concerned with because you're only doing one call, and the market again never makes huge violent moves up. It's really all about the puts, right? The put side is the danger, because if the market does drop, let's say the market drops 1,000 points tomorrow. So right now the SPX's last price is 58.70. Let's imagine it drops to like 4,900 tomorrow. You know, we're going to realize a loss at expiration holding this position of somewhere around $44,000-$45,000. You know, it's a big loss, right? And this is obviously just one contract. Now, Karen was trading the kind of numbers, like she was trading huge sizes here. An average size trade for Karen, I think she mentioned in one interview that she typically did about 500 contracts of SPX. That's huge, right? So you can imagine, you know, when you're dealing with that kind of money and the market does go against you in a big way, you can imagine, you know, the kind of stomach ulcers, right, that you would probably be dealing with. I can't imagine managing that much money and doing a risky strategy, because this is a risky strategy here, right? There's real risk in something like this, right? Because you could lose millions of dollars very easily if you wake up one day and the market has a drastic down move. Now let's talk about managing the trade. So she put these on, she put the 2 puts on around 56 days. She put the 1 call on about 30 days, but she didn't typically hold these to expiration. What she was doing, she would put on the puts at 56 days and she would manage them at 14 days. So she put them on at 8 weeks, and with 2 weeks left, she'd take them off. Winner or loser, they come off. The calls she was putting on about 30 days, and at 7 days, they were coming off. So she put them on about 4 weeks out, and with 1 week left, she'd take the call off. One thing Karen didn't do, she never rolled her positions as far as like rolling the untested side. Like she didn't move the strikes. Like if the market started moving down in a big way, she didn't start rolling down calls. She left this call on. It would just eventually become nearly a full winner, but she might add more calls along the way. Same thing with the puts. You know, if the market does what it typically does and just gradually drifts higher all the time, she's not rolling these puts up. No, the puts that are winning, they're going to keep keep winning, she may put on more puts along the way if she feels like she needs more long deltas. Maybe some of her calls are getting punished, so she just starts adding more puts. So that's all the adjustment she did. She would add puts when she thought she needed more long deltas. She would add calls when she thought she needed more short deltas. But as far as the tasty trade mechanics of, when the strangle's going against you, roll the untested side, she didn't fool with any of that. And I kind of like that. For me, constantly rolling options up and down as far as their strike price on a strangle, it's too much work, and it's always like you're fighting a loser. It never seems to, turn around. I mean, sometimes you do get a strangle that turns around on you, but for the most part, when they start losing, they're just going to stay losing. I like her idea of just, hey, this is option that I sold is either working or it isn't. And if it isn't, well, I'll just sell more on the other side, just to balance it out. Another thing Karen didn't do is she wasn't trying to be delta neutral either. She didn't care about having a certain delta number on her SPX position. She wasn't trying to hover around zero. She wasn't necessarily trying to lean bullish either or bearish. If she felt like she needed more puts, she'd sell more puts. If she felt like she needed more calls, she'd sell more calls. And she didn't really look at delta at all, oddly enough, because I would have thought that, it would all be about the beta weighted delta managing her position. But according to her interviews on Tasty, she really didn't care about the delta of her strangles. When she was asked by the TastyTrade guys whether she used technical analysis or fundamental analysis at all in her trading, she really didn't use any fundamental analysis. She's trading the overall market, so she really didn't care about fundamental analysis at all, macroeconomics or any of that. As far as technical analysis, she did mention that on her stock charts, her SPX charts, she did have the Bollinger Bands. I've got the Bollinger Bands here on my chart, and I guess she liked trading off of these. So, this is a 2 standard deviation line, the top line, same thing with the bottom line, 2 standard deviations, and obviously you've got a moving average in between. So when things start reaching the outer bands here, so for example, back in August 5th, when this candle broke this lower band here, that's more than a 2 standard deviation move that the market had made. She would be selling more puts then because the market has kind of been oversold at that point. So she wants to put on more bullish trades, more short puts when it's testing the outer band of the Bollinger Bands. And on the upper side, obviously, you'd be selling more calls when the candles are touching or breaking through that upper band. When asked about her overall buying power usage, she typically used about 50% of her capital to set up positions, which is pretty normal. It's kind of like a normal guideline most traders go by. They use about 50% of their buying power. They keep 50% of cash on the side for emergency reasons, because you never know when the market is going to do something crazy. She did mention, though, that sometimes she would use up to 80% of her capital in trades, maybe during really high volatility periods. Maybe she felt like there was more opportunity, and so she put on more trades. But again, she was taking a lot of risks. These strangles, these way out of the money strangles, they're already kind of risky trades, and she's putting on sometimes up to 80% of her buying power into these things. This is very high risk trading. Of course, with high risk comes high reward. That's part of the reason why she was able to turn $100,000 into $300 million. Now, how can you and me take some of what we've learned from Karen the Supertrader and actually put it to use in our trading? Obviously, we can't trade quite like Karen can, but what could we glean from some of the little nuggets of wisdom she shared in those interviews in the past? Well, if you guys like technical indicators like the Bollinger Bands, I have no problems with you guys using this for signals. I don't really use technical indicators. They're not my thing, even though I have them on my chart. I don't trade off of them. I don't treat them as signals. But if you guys want to, I have no problems with you guys looking at something like SPX or SPY or ES. And then, every time you are pushing this lower band, selling a put, or every time you're pushing up against this upper band, sell a call, play both sides based on the bands. Or if you don't want to take the kind of risk that Karen is taking with Strangles, do it with spreads. There is nothing wrong with doing credit spreads and iron condors rather than naked puts and naked strangles and naked calls. You could do this with credit spreads. When this thing is pushing the lower band, sell a put credit spread. When it's up against the upper band, sell a call credit spread. And maybe do them 2 to 1, the same ratio, because the SPX tends to go up more than it goes down. Do twice as many put credit spreads as you do call credit spreads. To me, That's a strategy that just kind of makes sense. I think it would work out. It's not a strategy I've ever employed. That's just me kind of thinking, off the cuff here. In fact, Karen, now she only trades her own money. She's not allowed to trade anybody else's money. She has mentioned in recent years that she does a lot more with credit spreads and iron condors now than just straight naked strangles like she did in the past. Of course, again, she's not really managing a fund like she was in the past. So these days, she's doing a lot more defined risk trades. So there you have it, some of my thoughts on Karen the Supertrader as far as some of the strategies she was using. If you guys are not familiar with Karen the Supertrader, go watch these episodes on TastyLive. Go watch all the interviews. They have 1, 2, 3, 4, at least 4 interviews that they did with Karen the Supertrader. The big ones are back in 2014. That's when she exploded on the scene, when they first introduced her to the world, because nobody had heard about her until this very first interview on TastyLive. And these are so inspirational. If you want to actually be inspired, if you want to feel like, hey, this options trading thing that seems so difficult and so complicated and so hard, if you want to actually be inspired and, somebody to actually make you think, you know what, I can make this happen, go watch Karen the Supertrader. Peace, guys.